Let's talk about the economy. Not from the skyscraper view, but from the ground level, the grassroots view. Our guide today is Danielle DiMartino Booth, the CEO and Chief Strategist of Quill Intelligence. Now, before we delve into the nitty-gritty, there's something macro that we need to address, something that's been overlooked by many. The Philly Fed Non-Manufacturing Survey. The service economy. It's supposed to be impenetrable, strong, unshakable. But recent data shows a different story. The numbers are falling off a cliff. It's breaking down. And it's not just Philly. We're seeing echoes of the same from the Richmond Fed. You might ask, why is this important? Well, the service sector makes up 80% of the US GDP, and it's the predominant employer. The signs are becoming clear. The future demand is absolutely collapsing. But the service sector isn't the only one struggling. Let's take a look at auto dealers. Some disturbing news is coming from there. Remember the subprime mortgage crisis in 2007? That's what car loans look like today. People are so upside down on their cars that they're walking away, leaving the keys with the dealers, trying to get a new car, a new loan because they can't afford to repair their old ones. The dominoes are falling. Repo men are in scarcity. There aren't enough of them to repossess as many cars as are being abandoned. This is the aftermath of people paying too much for cars during the pandemic, especially used cars. And speaking of loans, let's talk about bank loans for small businesses. The latest data shows that these are becoming increasingly hard to obtain. The key sectors of our economy that fuel jobs and growth are stumbling badly. And what's the implication of this? Small banks are up to their eyeballs in bad loans. This poses a risk to firms with fewer than 100 workers, the majority of employers in America. It's going to be difficult for them to get financing to grow their businesses. Amid all this, hedge funds have never been this bearish on Treasuries. It seems like we should all be bracing for some sort of economic Armageddon. The folks with the most money are betting against this economy right now. What does this mean for us? It means that the US economy might not dodge this bullet as quickly as we had hoped. The 10-year yield and the 2-year yield are moving in a way that suggests we're either in a recession or heading into one. This isn't the news we want to hear, but it's the news we need to understand. It's important to walk through this, to have foresight, to prepare for what's to come. As we delve deeper into this economic conundrum, let's look at the gravity of the current situation. Remember how confident we were about the service economy? We thought it was strong and impenetrable. But the truth is, even the strongest of fortresses can crumble. The Philly Fed Non-Manufacturing Survey provides a grim picture of the reality we're facing. The numbers have fallen off a cliff, a stark sign that the service economy is breaking down. And this isn't just an isolated incident. The Richmond Fed and the Dallas Services Survey echo the same sentiment. We're seeing a series of dominoes falling one after the other, indicating that future demand is collapsing. This sector, which constitutes 80% of the US GDP and is the primary employer, is showing signs of severe strain. Moving on to another aspect of our economy, the auto dealers. The news from this front isn't heartening either. Car loans today are ominously reminiscent of the 2007 subprime mortgage crisis. The weight of these loans is such that people are choosing to abandon their cars instead of repairing them. The ripple effect of this crisis is clear. There aren't enough people to repossess as many cars as are being abandoned. And the crisis doesn't end here. Small businesses, the backbone of our economy, are finding it increasingly difficult to secure bank loans. The sectors that fuel our economy's growth and job market are stumbling, and the situation is concerning. The repercussions of these financial struggles are significant. Smaller banks, burdened with bad loans, are at risk. This situation spells trouble for firms employing fewer than 100 workers, which represent the majority of American employers. These companies may find it challenging to secure financing, stunting their growth prospects. Amidst this gloom, there's an even more worrying trend. Hedge funds have adopted a historically bearish stance on Treasuries. It feels like the people with the most money are betting against the economy right now. The question is, what does this mean for us, for the average American? It implies that the US economy is not likely to escape this downturn as quickly as we had hoped. The shifts in the 10-year and 2-year yields suggest that we're either already in a recession or on the verge of one. While this isn't news we want to hear, it's news we need to understand. To navigate these turbulent economic times, we must stay informed and prepared for what's to come. Don't forget to subscribe to stay updated with our in-depth analysis and insights into the economic landscape. We're dedicated to providing you with the information you need to make informed decisions in these challenging times.